For the final exam review of ACCT 7060 Accounting for Managers, right? Today we are going to go through what I consider to be the most important slides as you prepare for your final exam. So if I bring you back to the first two sessions of the class, right? I introduced to you the accounting equation, right? If you guys remember, the accounting equation would be defined as assets equals to liabilities plus owner's equity. And this accounting equation should always hold in all transactions, right? And as well as on the balance sheet, when we see total assets must always be equal to total liabilities plus shareholders' equity, right? And what is shareholders' equity? This is kind of a abstract concept. So I've broken it down into two parts. The first part would be the capital stock, right? If you recall in the first class, I sort of introduced to you the concept of a lemonade stand, right? So imagine that you want to start a small business on campus to sell lemonade, and so you put in like $50 into the business, and that would form your capital stock, meaning that you own the business, and this $50 goes towards the starting capital stock. Of course, later on in class, we also covered what if firms want to issue more shares to raise more capital, right? Then that would also constitute capital stock, where anybody kind of from the open market can buy these shares and also own part of the business, right? So that is your kind of what we call the shareholders stock or common stock or capital stock. Right. So the other concept that we introduced was also the concept of retained earnings. So these would be the cumulative earnings of the company from the start of its business to the current date, right? Retained earnings appears as a balance on the balance sheet. And so we would have to calculate at each period, what is the ending retained earnings for that period? And how we calculate that would be to start with retained earnings at the beginning of the period, for example, 1st of January, right? Then we would add the net income for that period, meaning from 1st of January to 31st of December, right? And then we would less off any dividends declared and paid for that period. Okay, so this this equation would give us the ending retained earnings as at 31st of December, which would then be reported onto the balance sheet. Okay, and so how do we calculate net income? Over here, net income would be total revenue minus of your total expenses to get the net income for the year. And so revenue minus expenses would be shown in a statement called the income statement. All right, so this slide is just to kind of recap what is the accounting equation, what are the different components making up of the accounting equation. Now, furthermore, right, I introduced the concept of accounts, right? And the purpose of accounts is really to track the increases and decreases in the financial statement items, okay? What are financial statement items? For example, cash, accounts receivable, inventory, accounts payable, so on and so forth, okay? And we use what we call the T account to track these increases and decreases. It is called a T account because of the letter T over here. All right, and there are three elements for each T account. At the top, we would have the account title, okay, for example, cash or accounts receivable. On the left-hand side of the T, we would have the debit side, right? Whatever amounts we want to debit. And on the right-hand side, we would have the credit side, meaning whatever amounts we need to credit to that particular account. How do we remember if it is debit or credit, right? I introduced to you the picture of DC, okay? So DC, D is on the left and C is on the right, meaning that debits always go on the left side and credits always go onto the right side. Okay. Furthermore, I introduced the concept of double entry accounting, where every transaction, right, must be recorded by equal dollar in debits and credits, meaning that when you write a journal entry, the total debits must be equal to the total credits. And this is how we ensure that the overall accounting equation still continues to hold. Right. Besides what we call the regular journal entries, I also introduced to you the concept of adjusting entries. Right. We have to do adjusting entries at the end of each financial period for a variety of reasons. Right. And one kind of important reasons would be what we call supplies. Okay, so supplies are kind of a special item because we do not account for every pencil that we use, right? For example, supplies is made up of a lot of pencil, stationery, kind of individually minute items, right? And so we do not update the accounts every time we use them, but rather we would just take the ending and the starting and figure out how much we used in between. Okay, so in this example, right, at the end of November, we had $1,800 of supplies left over, right? And at the end of December, we realized that a physical count shows only $1,200 left over. Okay, this must mean that during the month of December, $600 of supplies was being used. How did I get $600? It is simply $1,800, the beginning balance, minus $1,200, which is the ending balance, right? That gives me $600. So how do I account for adjusting entries? Okay, so first up, we would have to record the expense. Okay, so if you recall, right, expenses is part of retained earnings, and expenses actually decrease retained earnings, right? So if it decreases retained earnings, it also decreases shareholders' equity. Shareholders' equity is on the right-hand side of the accounting equation because A equals to L plus E, and so on the right-hand side, it increases on the right. Okay, so DC, if I want retained earnings or I want shareholders' equity to decrease, I would actually have to use debit. Right? It increases on the right, it decreases on the left. DC, D is on the left, and therefore I debit supplies expense to show that I've used up $600 worth of supplies. Now, on the credit side, right, we would then have to credit the relevant inventory account, which would be supplies in this case. Okay, supplies is an asset account because we own the stationery, right, and we are entitled to use the stationery for our economic benefits. So supplies is an asset account. Assets is on the left-hand side of the equation and therefore increases on the left. DC increases on the left, meaning I debit to increase, I credit to decrease. To show the decrease in supplies, I would then credit supplies $600. Okay, so this is a classic example of how adjusting entries would be done for recording supplies. Now, the other kind of adjusting entry that we went through in class, right, and also through your various assignments and in-class practices would be the concept of depreciation, right? So once again, depreciation would mean we have a large cost for a particular asset, a long-term asset, right? And we do not want to take it as an expense in the year that we buy it because we are going to use it over a period of time. So what we are going to do is to allocate kind of this large sum of money over the course of its useful life. Right? So for example, if I buy a building and I intend to use it for 20 years, I am going to allocate the total cost of the building over the 20 years so that my expenses do not take a big hit in the year that I use it or in the year that I pay it, but rather across all the years that I'm going to use the building for. Okay, so in this example, right, we purchased a $36,000 building on 22nd of January and it has a useful life of 20 years. So if we consider kind of a straight line depreciation, which is a simple average, right, we are going to have $36,000 divided by 20 years times 12 months in a year, right? That would give us $150 for monthly depreciation for this particular building. And so the adjusting entry just for the month of December would be, first up, debit depreciation expense building $150, right? And second, credit accumulated depreciation building $150. Okay, so just to kind of remind you that for accumulated depreciation, it is a contra asset account, meaning that it's going to reduce the net value of our assets. So on the balance sheet, we would see buildings, right? So buildings, $36,000, this line item doesn't change. The next line we would have on the balance sheet would be less accumulated depreciation building. And for example, if it has only been depreciated for 1 month, less accumulated depreciation building, $150. And finally, the net book value of the building, which is 36,000 minus $150. Okay, so accumulated depreciation is a contra asset account, reducing the net book value of our assets. And very importantly, when you guys write the accounting or adjusting entry, you should always specify the asset for which the accumulated depreciation is for, right? In this case, that would be building. All right, the other kind of adjusting entry that we also discuss in class would be to accrue uncollected revenue, right? Where in many cases we actually perform the services or we deliver the goods, but we have yet to receive the cash and probably only going to receive the cash after year end. Okay, so as at year end, right, we have to record the revenue that we have already earned, even though we have yet to receive the cash. So in this example, right, on 15th of December, we sign a new contract to provide maintenance service for $1,500 a month, and the first monthly payment is going to be due after year end, right, 15th of January 2022. So how do we account for the maintenance service that we have already provided from 15th of December to 31st of December, right? That is 2 weeks worth of maintenance service that we have already provided. So we are going to take $1,500 divided by 2, right? Because that is 2 weeks of maintenance service, right? So it's half a month being provided. And we are going to debit accounts receivable, $750, okay? And credit service revenue, $750. Right? So the key here is that we record the service revenue that has already been provided from 15th of December to 31st of December, right? And to remind ourselves, kind of to collect the cash later on, we have to debit AR to show that there is a receivable after the year end of $750. Okay, so kind of as an extension to this example, right, what is the entry that we're going to do on 15th of January, right, when the kind of the first monthly payment is going to be made? Okay, first we are going to debit cash $1,500 because in the contract it is stated that there is a monthly payment due on 15th of January, so that is for the full amount of $1,500. Okay, second, we are going to credit AR, right? This is to reverse the AR that was first accounted for on 31st of December. Okay, so if I have a debit balance of AR 750, I credit AR to show that the cash has been received, and so AR balance should now be 0. Okay. Furthermore, from the 1st of January to 15th of January, I also provided 2 weeks of maintenance service, and so I should record 2 weeks of service revenue, $750. Okay, so this is kind of an extension to the adjusting entry when we receive the payment later on. All right, so after we have done all of our adjusting entries, right, I also introduced to you the concept of an adjusted trial balance, where the adjusted trial balance must be updated to include the amounts after adjusting entries, right? So for example, right, accounts receivable has been updated as at year end, right? We increased it by $750. So if I were to provide you the trial balance pre-adjustment, okay, you are going to add the $750 to AR account to arrive at the adjusted trial balance post-adjustment. Right, so this 7250 here should include the increase in $750. Similarly, for shop supplies, right? Say that the trial balance I provide to you is pre-adjusted, meaning that shop supplies is only going to show $1,800, right? But because we reduce shop supplies by $600, the adjusted trial balance that you're going to prepare should show the updated amount post adjustment, which is 1,000.